Hey guys, we're here for our next session. It's going to be on constant function market makers, pushing Uniswap and friends to do more with lower fees. Can our speakers introduce themselves? And for the audience, can you confirm you can hear them?
Cool. Yep. Go ahead.
So I'm Guillermo Angeris. I'm a PhD student at Stanford doing some work with Tarun, actually.
I'm Tarun. I started a company called Gauntlet, and we do a lot of research on economic stress testing of crypto protocols.
A quick thing. So it seems the chat has broken again for Crowdcast. It broke 2 times already today. So for the audience, if you can just let us know you can hear us in the ask a question section, because that seems to be what works now, that'd be great. Can you confirm?
I see a question. Oh, no, that's...
No, that's me.
I see that people can hear us.
Okay, perfect. Someone answered. Go for it.
Yep.
Great. Cool. Cool. So yeah, today we're going to talk about constant function market makers. Constant function market makers are sort of a natural way of generalizing Uniswap, which has been kind of super successful and exciting, in a way that captures all of some other types of trading and asset management smart contracts and mechanisms that have evolved over the last year. And you know, we basically have written a paper that kind of gives you some conditions on when these types of constant function market makers work, what kind of returns you should expect, how you should think about setting fees, and more. And this talk is really going to be about giving a high-level overview without diving into the math. And of course, you know, for more, definitely read the paper. But we wanted to give kind of like a simplified version of the world. Yeah. And so to do this, we're going to kind of start by first looking at the history of these market makers. It turns out they have quite a varied history that goes pre-cryptocurrency, to be honest. And then we're going to go through a couple examples and then kind of go through the main geometric objects that we analyze in the paper, but use pictures to describe them instead of math. Cool. So what is the point of a constant function market maker? Well, the goal is really to try to automate trading assets. But let's take a step back and look at how trading assets has worked before. Normally, if you have two parties, you have one party who makes an offer for how much, saying that they want to buy at a certain price, and you have another person who says they want to sell. And once they meet or they cross, you are basically able to have a trade. Now, imagine that you have a good where you have many buyers and many sellers, all with different preferences and different desired quantities and different prices they're willing to pay. One way of consolidating all these pairwise trades into something that can clear the whole market is known as an order book. And in an order book, you have buyers who post bids of the maximum price they're willing to buy for, and sellers who post asks or the minimum price they're willing to sell for. And these also include quantities. So a buyer might say, I want to buy Ethereum for $200 per ETH. And the seller might say, I want to sell Ether for $200.01. And if there exists a buyer who is willing to pay $200.01, then a trade happens and a trade occurs. And basically, this is how order books work. They kind of ameliorate this pairwise trading behavior into something where you can have many-to-many trades at once. But they have some disadvantages, and these are kind of very important in the cryptocurrency space, especially as block space is expensive and compute is difficult. So the first thing is a trusted party keeps a record of all outstanding bids and asks. And so obviously in the cryptocurrency case, that means that the blockchain itself would have to hold such things. And one of the reasons this can be bad is that this has a linear space requirement. This means that you have to store a linear set of the data structure involved has to grow linearly with the number of bids and asks and trades. And because the behavior of the system evolves by having the highest bidder having to bid, being willing to pay more than what the lowest asker wants, the price update might be very slow, especially when you have a small number of market participants, which basically means low liquidity. And in normal markets, exchanges usually have to add subsidies for less liquid assets or less traded assets to ensure that there's liquidity. And these subsidies can be expensive and are kind of manual in the normal trading world. So what are some alternatives to kind of the order book? The order book is a very very well-trusted thing. Trillions of dollars are traded on order books per day. It's survived for hundreds of years and has not had many competitors who have been very successful. The thing is, order books are much more human-driven in a lot of ways. Yes, they're algorithmic trading strategies, but someone has to maintain the order book, and usually in the centralized world, that's an exchange: NYSE, NASDAQ, CME, Coinbase. But could we replace them with algorithmic market makers? And the answer is yes. There are automated market makers. And the thing is, you have to tune them correctly to meet a lot of requirements that you're kind of used to having in the order book case that it turns out are not obvious in the automated market maker case. Some of these properties include bounding the loss, the total loss that the automated market maker can take, because in the same way that a market maker could lose all their money or potentially more money if they're super leveraged, you want to ensure that the automated market maker is sustainable. The other thing is you want kind of this intuition that if I trade 2 Ethereum in a market that has 10 Ethereum of liquidity versus 2 Ethereum in a market that has 100 Ethereum of liquidity, the price move caused by the latter trade should be much smaller than that of the former. And the last thing is you really want a small storage, a sublinear sort of data structure requirement. And this really boils down to accepting or rejecting trades based only on certain price properties. So if we go to the history of automated market makers, we kind of go back to these papers by Savage in the 70s and Robin Hanson in 2002. And the idea is quite simple. So assume that you have participants who are known as liquidity providers who own a bunch of an asset and want to earn some yield on it. And what they do is they pool their assets, let's say they're 2 assets, A and B, into reserves. These reserves are used to help price the price of A in terms of B and B in terms of A. If the price is set too low, agents buy reserves at the current price. And if the price is set too high, then agents can go to another market, buy an asset, and then sell it to the reserve at the current price. And by doing this, you kind of are able to ensure a sort of arbitrage loop. The idea then is to actually have the prices completely controlled by the reserves. And what this means is that the price is only a function of the reserve. That means, for instance, that if there's too much of asset A relative to B, you can decrease the price of A. It's less scarce than B in some sense. So let's go through some examples. So the simplest example of automated market maker is a fixed asset price at all reserve amounts. And a kind of a quip I've heard people say is that this is sort of like a central bank. Regardless of what quantity you take, what reserves you use, you get a fixed price. You get $1 for $1. Now, obviously, this isn't always true, especially when we have the gold standard. Things are slightly different, but in fiat land, this you could to zeroth approximation think that that's true. Another example is reporting the price as the ratio of the 2 reserve assets. And this is what Uniswap is. So let's go through kind of a brief history, because I think in the cryptocurrency space, there's a lot of belief that the automated market makers, and especially the constant function market makers, were sort of invented within the space, but they actually have quite a long history in algorithmic game theory. So the first thing was logarithmic market scoring rules, which can be used for automated market makers and prediction markets, and things like Gnosis want to use LMSRs. They use something slightly different right now. And then the first sort of more mathematical framework for defining different types of market makers was this paper by Chen and Pennock in 2007. And this paper set an axiomatic framework that says, if you have an automated market maker that satisfies certain rules, then you can guarantee that it has bounded loss, or it has more than a certain threshold of liquidity. And then Othman and Sandholm took that one step further, and they basically invented liquidity-sensitive automated market makers that don't have unbounded loss. So until this point, it was actually quite hard to really bound the loss. And I think they extended the kind of Chen and Pennock framework. And then in 2011, Othman and Sandholm wrote a paper that was the closest you can get to Uniswap and constant function market makers, but it's just slightly different. And this paper was basically involved constant utility automated market makers for prediction markets, which basically said agents' utilities were invariant under trades. They didn't change under trades. They were kept constant, which ended up being sort of very closely related to Uniswap, but not quite the same. And finally, there's a series of Reddit posts from Vitalik and Martin Koppelman of Gnosis, where they are talking about sort of these kind of prediction market scoring rules and trying to figure out if there's a way to turn them into something that can be used for a normal market, not just a prediction market. So we'll go through a couple examples. So the first one, which many of you are familiar with, is Uniswap. And Uniswap basically says, I have two assets. In this case, we denote them alpha and beta. And there's a contract that has reserves for them, and there's an invariant that must hold, which is the product must be kept constant. And we'll call this the trading function, because this function really, this invariant that must be satisfied, of course, this is in the feeless case, is sort of the thing that defines a lot of characteristics about this market, as we'll see. In this case, we'll assume alpha and beta are coins, but they're really any representable asset the contract can deal with. And basically, to satisfy this equation, the marginal price of the asset must be their ratio, as mentioned. So the Uniswap function, as you can see displayed here, is this kind of hyperbolic shape in 2 dimensions. And there are a number of points that you could be on this curve that give you the price of B in terms of A or A in terms of B. And as long as the resulting reserves stay on this curve, these are allowable trades that can happen. So Uniswap's really easy to analyze. The trading function is extremely simple. It's a plane curve. It's smooth. It's continuous. It's bounded away from 0. But what about more complicated cases? Balancer, curve, shell, every week there's a new one that's coming out nowadays. Well, we could work out sort of these ways to get prices via implicit function theorems, which is sort of where this ratio comes from that curve. How do LP returns work? If I'm providing liquidity to these pools, how do I try to estimate how much money I can make? Are these curves chosen in a way that's good or bad for our treasurers? Additionally, one thing that you oftentimes do in math is you try to take an object and you take the set of symmetries of that object and you mod out by those. And in this case, we want to kind of mod out by the trading functions that give the same trade. And now I'll get to Guillermo.
Cool. Yeah. So kind of the big idea that this paper presents, as Tarun mentioned, in mathematics, we usually try to simplify things by modding out or by removing symmetries. It's a notion of a trading set, which will seem kind of silly at first, but I promise it actually has a weird, useful purpose. So what we're going to do is we're going to fill in the graph and fill it in big quotes. Essentially, we're not only going to allow trades on the curve itself, but we're also going to allow trades for which reserves are greater than those points. So in particular, any trades on the graph which lie above, any points on the graph which lie above and to the right of the curve are also going to be possible. So in particular, if we take the Uniswap curve that we were looking at previously, the new set is going to look like the points along the Uniswap curve, right, or along the Uniswap trading function, which are the dark blue curve. And then we're going to add in all of the lighter blue points, right, which are those which are above and to the right of this curve. This is similar to the notion of epigraph in convex optimization. Some people are familiar with this. So, of course, we've only added points, right? So all of the reserves that were previously feasible are still perfectly valid. But one could imagine, like, look, someone's going to put a point on this curve, or that's not along the curve, but rather is inside of the trading set. What's actually interesting is that no rational trader is actually ever going to pick a point on the interior of the set. Why? Because any point below and to the left of this point, right? So any point along the boundary is always going to be cheaper. In this case, for a trader to get to the red point, they have to perform the same trade as the 1-1 point in black. Yet they also have to provide 0.5 more of coin A and 0.25 more of coin B into the reserves. So they come out strictly losing by essentially trying to put a point in the interior of this set. So we'll give the set is kind of nice, and we'll give it a name called the trading set, or T for short. And it will be a subset of the positive plane in 2 dimensions, although we will show that this can be generalized to any number of coins. So the reason why we've defined this, and again, it seems silly, right? We've kind of added a bunch of points and then said, oh, it doesn't matter, they're kind of redundant, is that actually the trading set itself is often, if not almost always, easier to deal with than the actual trading function. And as we said before, rational agents will always opt to, if they trade with the trading set itself, which has all of these extra points, or they trade along the curve, it doesn't really matter. They're going to do perform the same actions. So another thing that is really nice about it is that many trading functions might yield the same set, but the set itself is always unique. Perhaps the nicest, though, of all of the possibilities is that the trading set is often convex in practical scenarios. And hilariously, it's actually convex in all of the known constant function market makers. So that includes Uniswap, Balancer, Stable Swapper, Curve, etc. In math, as some might know, convex implies 2 very, very nice things. One is that it is easy to optimize problems subject to constraints in convex sets. And B, we have a huge amount of very powerful mathematical tools which allow us to analyze geometric properties of these sets. And we'll use these to kind of give very general theorems about, things like returns or stuff like that. So we'll provide, again, there's a lot of mathematical detail that goes into this, and if you're interested at all in it, we'd highly recommend reading the paper, but we'll give a kind of a taste of the results in the easy, quote unquote, case of no fees for these constant function market makers. So what's surprising is that any constant function market maker for which the trading set is convex will have exactly the same properties. And those are A, that the marginal prices are easy to compute, B, that the arbitrage problem is actually computationally easy. So that implies that arbitrageurs are perfectly incentivized to try to make the prices reported by the constant function market makers match those of a reference market. So essentially it means that the CFMM is likely to be it gives an idea that it might be a good oracle. Another thing that's kind of surprising and not known until now, I think, is that we can compute liquidity provider returns and almost always in closed form, even for really, really complicated CFMMs. Again, all of these facts, I've kind of set them very nonchalantly, but they follow from basic convex analysis. So let's talk about the marginal price. So in this case, a CFMM at given reserves has a marginal price, and the marginal price is actually proportional to the slope of the supporting hyperplane at these reserves. So in this particular case, I have a Uniswap market whose reserves are two coins or two of coin A and 1/2 of coin B, the slope of the resulting hyperplane is 1/2 for A and 2 for B. So essentially this means that coin B is worth 4 times as much as coin A. This is important, and this proportionality idea is actually very important because you could choose your base currency, also known as your numeraire, to be whatever you want, right? If I choose it to be A, then essentially I seek to make the first entry of 1/2 comma 2 be equal to 1. So I would multiply the entire vector by 2, right? And so the resulting price would be 1 comma 4 in terms of currency A. On the other hand, if I chose B, it would be 1/4 comma 1, as one might expect. Another thing, as we mentioned before, is that you can actually provide the liquidity you can actually give the liquidity provider portfolio value as a very simple optimization problem. And it's exactly given by the minimum of the price times the reserves, such that the reserves are in the feasible set or in the trading set. And of course, P here is the vector of prices for coin, such that index I has the price for coin I. This is extraordinarily close to a very well-known kind of definition in convex analysis called a support function, which usually means that a bunch of people have worked out a lot of these support functions for a lot of these sets. And additionally, even if we couldn't analytically work them out, they're almost always easy to evaluate in terms of computationally easy to evaluate. So numerically, we can always write what the resulting value is to any precision we might want. This, as before, it gives the first way, at least known to us, of analytically computing LP returns for things like the N-coin balancer case, which is, to our knowledge, not previously known. And it turns out that actually the derivation is about half a page only using this formalism. So another question, you say, yeah, fine, whatever. Convexity is great, it's easy, whatever. But, I could take a chunk out of that convex curve and, what happens then, right? So it turns out, kind of funnily, is that arbitrators won't generally care about the non-convexity, right? Because the marginal price at the points in which it's not convex is the same as if we filled the curve, right? So if we were to, these two curves are in some sense equivalent to arbitrators. They don't care whether it's non-convex or not. They will always opt to work with a convex version of it and solve the same problem. So in some sense, under this framework, you don't actually gain any power by adding non-convex sections to the curve. So we might as well treat all of them as convex. And as we've seen in practice, almost all of the curves that were given are convex indeed. So of course, as before, this is a 1,000-foot overview of the paper. You can easily extend this to include fees. So we've discussed the fee-less case, also known as the path-independent case. In the case with fees, you have a slightly weaker property called path deficiency. But in this case, the trading set T actually changes after each trade, which makes it a little bit more complicated to analyze. And you have to set up your definitions just right to be able to say things about the marginal price and stuff like that. As before, we were working in the two-dimensional case. So the reserves only depended on 2 coins, but you could imagine that they could depend on n coins, right? And exactly the same results hold in roughly the same way. There's a few questions. Can we say how much does it cost to actually manipulate this oracle? Or can we give lower bounds on the reserves? Could someone adversarially drain the reserves by performing weird trades? So overall, kind of a general quick summary is the idea is to recast all of these numerical properties of constant function market makers as well-known geometric properties of convex sets. These geometric properties let you talk about everything that you might want. They're equivalent, so the trading set itself is equivalent to a trading function. So we can talk about anything from marginal prices. We can say the arbitrage problem is easy. We can talk about liquidity provider returns. Another crazy and weird idea is that it allows us to optimize over the set of constant function market makers, right? So if you have a specific application, you might say, look, I want to set the fees and the curve shape in such a way that it could maximize my liquidity provider returns, or it could maximize any function itself of this trading set. You can imagine there's a whole zoo of possibilities here, right? Because now you've turned a problem of having some random math PhD sit down and write a bunch of equations and try all of them out to feeding the problem to a computer, right? And having the computer itself figure out what an optimal constant function market maker is. So I just will leave you with that. We'd like to thank a few people for making the paper and the slideshare possible. So we'd like to thank Tim Roughgarden from Columbia, John Mara from Gauntlet for comments and some edits of the paper, many of which were quite useful. And we'd like to thank Shane Barrett from Stanford for finding a few interesting bugs in the presentation.
Cool. I saw one question, which was which was the following: don't you think that Bancor was the first AMM in crypto, almost zero ahead of Uniswap? I think so. Regardless of who was first on mainnet, the idea of automated market makers on Ethereum existed far before Bancor existed. If you look at the set of Reddit posts by Vitalik and Martin Koppelman, those go back to 2015. I think the thread was one of the first threads was pre-DAO. So Bancor versus Uniswap is kind of like an irrelevant question to that. But the more interesting thing, and like it's not, I think the thing that you should really take away is that people in other fields, namely algorithmic game theory and online optimization, had basically come up with the same thing 15 years ago. But like they didn't know what use case it would be useful for. And so people in Ethereum land kind of rediscovered it. And then it happened to map well to the cryptocurrency use case. But it's not something that's super novel. And I think that's kind of the thing to take away from the history, is that, like, you know, people had actually really come up with most of the ideas. They just couldn't figure out what an application was until Ethereum was a real mainnet. It was real live on mainnet.
So I think we have one question on the chat, actually. So the same theory is used in present-day fiat financial markets. That's a generally good question. So the same ideas of general convex optimization are used because they are simple to optimize. But it turns out the nice part about AMMs is that they necessarily follow this automated curve, or this like particular constant function, which lets you say a lot more than it lets you say about normal markets. So normal markets, you usually have to assume a model for the market itself, and the behavior itself might not be necessarily rational, or it might be rational in a different way than you assumed. CFMMs kind of restrict the space of possible actions and of possible, results, I guess, to just being like a very mathematically fixed relationship. So in some sense, yes, the answer is yes, because people usually assume some type of model for markets, and then afterwards do Markowitz portfolio optimization or do other types of game theoretic constructs to answer, or to like try to, in the case of HFT, outbid people or front run people. In some sense, the answer is no, because free markets have much more degrees of freedom, and so the models themselves may not necessarily be, convex in the same way that CFMMs are, and all of these things.
And I'd add one other thing, which is I think it was Virtue as mentioned. I mean, Virtue is just a trading firm that trades on these, like they're like a kind of broker dealer and flow internalizer that does trade on normal exchanges. One of the things that is unique about these constant function market makers is that they are kind of useful for the low liquidity situation in a way that order books are not. So in kind of the beginning of the presentation, we talked about how order books are efficient when you have a lot of agents and a lot of liquidity, like a lot of supply and demand. And that's for markets that Virtue is involved in, that's like they're never really trading on super liquid things. So this is more a way of kind of replacing the if you want to think about an example in normal finance, if you try to buy corporate bonds, you'll call up someone at Jefferies and they'll give you a quote. This would replace that, like the kind of low liquidity markets that may have high ticket size.
Right.
All right, awesome. This was a really great session. Sorry the chat was broken.
No worries.
So
No worries.
we're going to end the session now and go to the next one. Thank you so much again for your time.
Yeah.
Cool. Thank you.
Yeah.
Thanks.